AirAsia X dismal financial performance has raised questions on the viability of the low-cost long-haul model of the carrier. For AAX shareholders, it has been a bumpy ride, with the share price now trading around 58 cents, less than half of its initial public offering price of 1 ringgit 25 cents.
While the low-cost model has worked for AirAsia Berhad's short-haul flights, investors might be spooked by AAX's inability to return to profitability so far. For its latest financial year ended December 31st, 2014, net loss more than quintupled to 519.35 million ringgit from 88.27 million ringgit in losses the year before. From a quarterly perspective, losses rose 27% to 168.43 million ringgit in the fourth quarter of financial year 2014, compared with 132.6 million ringgit in the fourth quarter of financial year 2013. Allianz research analyst Tan Ki-hung said in a February 25th note that the fall in jet fuel prices will unequivocally be good for AAX's bottom line, but it would not be sufficient to return the carrier to the black due to the competitive operating environment. AAX is likely to pass on a significant portion of the fuel cost savings to consumers. Another challenge for AAX so far has been its loss-making routes. So far this year, the airline has discontinued its flights to Adelaide and Nagoya that were incurring losses to the group. It also slashed the frequency of flights to Sydney, Perth and Melbourne late last year. AAX also proposed a cash call on January 30th for a renounceable rights issue with free attached warrants. This could raise 395 million ringgit that the carrier intends to use for working capital and to service its loans.